There is a strange thing that happens inside your super account once you cross $100,000. It is invisible on your statement, your fund will not send you a letter about it, and most Australians completely miss it. But the moment your balance crosses that line, the maths flips in your favour. From that point forward, the heavy lifting is no longer being done by you. It is being done by your money. And that single shift is the reason some Australians retire with $800,000 while others, earning almost the same income their whole life, retire with 1.8 million. So let me show you exactly why everything changes after $100,000 and what you should be doing the moment you get there. For the first 10 or 15 years of your working life, super feels slow. You look at your balance and it barely moves. Your employer puts in 12%, the market does its thing, and yet the number on the screen seems frozen. That is not your imagination. That is real. Because in the early years, your contributions are doing almost all the work. The growth from investment returns is tiny compared to what you are putting in. If you have $20,000 in super and the market goes up 8%, you earned $1,600. That is less than 2 months of your employer contributions. And this is exactly the stage where most Australians give up, stop checking their balance, and accept whatever the system hands them at retirement. That is the most expensive mistake you can make in your 20s and 30s, because the people who push through this slow stage are the ones who end up wealthy. There is also a psychological trap that catches people during these early years. When the balance moves slowly, the brain stops believing the system works. People begin treating super like a tax instead of a savings account. They stop opening their statements. They forget which fund they are even with. And then one day they wake up at 45, look at the number, and realize they have lost 2 decades of momentum to apathy. But something shifts around the $100,000 mark. At a balance of $100,000, an 8% return generates $8,000 in a single year. That is $8,000 added to your retirement without you lifting a finger, without working a single extra hour, and without saving another cent. Once you cross 100,000, your super becomes a second income, working in the background, taxed at just 15% while you sleep, while you holiday, while you scroll your phone on the couch. Now here is where it gets really interesting for Australians specifically. Super is the most tax-advantaged investment structure most of us will ever touch. Inside super, your earnings are taxed at a maximum of 15%. Outside super, the same earnings could be taxed at 30, 37, even 45% depending on your marginal rate. So every dollar that compounds inside super grows faster than the same dollar compounding in your bank account or your brokerage app. That tax wrapper combined with compounding past 100,000 is genuinely one of the most powerful wealth-building combinations available in this country. So if you are sitting at $40,000 or $60,000 or $80,000 right now, the most important financial move you can make is to push hard to get yourself across that line as quickly as possible. Because every year you delay hitting 100,000 is a year stolen from the back end of your retirement, where the growth would have been enormous. Here is how to speed it up. The first lever is concessional contributions. For the 2025 to 2026 financial year, the concessional cap is $30,000. That includes what your employer puts in. So if your boss is paying in around $11,000 a year, you still have roughly $19,000 of headroom to top up before tax. These contributions are taxed at just 15% inside super, instead of your marginal rate, which for most Australians is 30 or 37%. That is an instant tax saving and an instant boost to your balance. If you have unused cap space from the last 5 years and your balance is under $500,000, you may also be able to use the carry forward rule to contribute even more in a single year. This is one of the most underused strategies in the country. The Australian Taxation Office tracks your unused concessional cap space automatically, and you can see exactly how much room you have through your MyGov account. For someone who has been part-time, on parental leave, or just never topped up super before, this can mean catching up tens of thousands of dollars of contributions in a single year, while slashing your tax bill at the same time. The second lever is non-concessional contributions. For the 2025 to 2026 financial year, the after-tax cap is $120,000 per year. If you have come into money, a tax refund, an inheritance, a bonus, a sold asset, this is a way to fast-track yourself past the 100,000 mark in a single move. The bring forward rule may also let you contribute up to 3 years' worth at once, which can mean putting in $360,000 in one financial year if you qualify. For Australians who suddenly receive a windfall, this is one of the fastest legal ways to move money into a low tax environment. And keep this in mind. From the 1st of July 2026, the concessional cap is rising to $32,500 and the non-concessional cap is rising to $130,000. So if you are watching this near the new financial year, you have even more room to move. The third lever is investment choice inside your fund. Most Australians are sitting in their fund's default option without ever checking it, and many defaults are still too conservative for someone with decades until retirement. A higher growth option historically returns 1 to 2% more per year than a balanced option. Over 30 years, that gap can mean hundreds of thousands of dollars. Log in to your fund this week and look at exactly what option you're in, what the fees are, and how it has performed over the last 5 and 10 years. If you are under 50 and sitting in a balanced or conservative option, ask yourself whether that risk level actually matches your time horizon. You have decades for the market to ride out any short-term volatility, and choosing growth over comfort in your younger years is often the single biggest decision you will ever make for your future balance. Now, a quick word on the bigger end of the scale, because Australians are talking about it everywhere. The new Division 296 tax on super balances above $3 million is now law. From the 1st of July 2026, balances above $3 million will face an additional 15% tax on the earnings attributable to the portion above that threshold, with the first testing date being the 30th of June 2027. For the vast majority of Australians, this threshold sits far beyond anything you need to worry about today, but it is a clear signal from the government that super remains the most tax-effective wrapper available, right up to very high balances. The system still rewards you enormously for using it. So if you are not yet at 100,000, get there fast. Salary sacrifice a little more this month. Check your investment option this week. Consolidate your old super accounts if you have more than one. And if you are already past 100,000, congratulations. The hardest part is behind you. Now your job is simply to stop touching it and let it do what it was designed to do. The Australians who win this game are not the smartest or the highest paid. They are the ones who understood compounding early and refused to interrupt it. Because in 20 years, you will not remember the market dips, the headlines, or the politics. You will only remember the day you finally understood why everything changes after you hit 100,000 inside super. If this gave you a new way to look at your super, hit that subscribe button and share this video with a friend who needs to see it. Thanks for watching, and I'll see you in the next one.